Welcome to the deep dive. Today, we're going straight into the real core of it, what separates the consistently profitable traders from, well, everyone else.
Yeah, and our main source here is the wisdom of MDG Glass. You probably know him as Mark Douglas, author of trading classics, The Disciplined Trader, Trading in the Zone.
Right. And he's been coaching traders since way back in '82. Worked with big investment funds, floor traders, the whole spectrum.
So our mission today, really, for you listening, is to kind of distill the essence of how a professional trader thinks.
We want to uncover that fundamental mental approach, right? The one that leads to consistent wins and lets you trade without, that fear constantly nipping at your heels.
Because that fear, turns out it's the big one, the real stumbling block.
According to MDG Glass, yeah. The biggest challenge isn't finding the perfect system, it's actually executing your trades flawlessly.
Without hesitation, without doubt, without those internal arguments that just stop you in your tracks.
And what's really fascinating, the fundamental insight he offers, is that pretty much all trading errors, they come from a lack of confidence.
Specifically, trading in fear. When fear takes over, it just warps how you see things, undermines your discipline. It's huge.
But here's the good news, the empowering part. Trading without fear isn't some, innate talent.
No, it's a skill, something you can actually learn and develop like a muscle.
And that skill, that's the crucial difference. That's what separates the pros from the amateurs, fundamentally.
So the promise of this deep dive is pretty straightforward. We're going to unpack the key mental insights, maybe some techniques to help you build that professional confidence.
Yeah, this isn't about some secret magic formula. It's about unlocking the full power of whatever method you're already using by getting your head right. Mastering the inner game.
Okay, so let's really dig into this. Thinking like a professional trader, what does that actually mean beyond just, making money?
Because, let's face it, anyone can get lucky on a trade here and there. That's not professionalism.
Exactly, professional thinking. That implies consistency. It means being able to generate a stable equity curve, that chart of your performance.
You want it going steadily up, not looking like a roller coaster.
Right. Professionals are aiming to become experts. People capable of managing serious funds or trading full-time, making it their sole income.
Just think about it from your angle. If you were handing over money for someone to trade, who do you pick?
The guy whose results are all over the map. Massive wins, massive losses.
Or the one with that smooth, steady upward climb? It's kind of obvious, isn't it?
It really is. And to get that kind of reliability, pros develop a completely different way of looking at the markets, a whole different mental framework.
So to illustrate this, let's look at MDG Glass's own journey. How he went from amateur to pro. Because his early days, even though they were decades ago,
they really mirror the challenges so many traders face today. It's uncanny.
Absolutely. He started trading potato futures way back in 1978, Chicago Board of Trade.
A market that doesn't even exist for potatoes anymore. He even said he couldn't quite remember why potatoes. Probably just a broker tip.
Yeah, and guess what? His very first trade was a winner.
Uh-oh. And just like with so many new traders, that first taste of success, it bred overconfidence.
He remembers thinking, why haven't I been doing this forever? That feeling.
Oh, yeah. I'm sure many listening can relate to that exact thought early on.
So then he moved on, traded gold and silver. And here's the thing. Despite the insane tech advancements since then,
his early struggles, they sound remarkably like what new traders go through now.
It's almost hard to wrap your head around what trading was like back then.
It really is. MDG Glass often talks about how amazed he is by today's tech. Back then, everything was manual. You had to pick up the phone, call your broker.
Just imagine the delay. You decide to trade, dial, wait, relay the order.
And the potential for broker bias. He tells this story about wanting to buy gold, and the broker says, well, our biggest clients are selling.
What do you even do with that? Instant doubt. Internal conflict. Messes with your own analysis.
And the uncertainty about getting filled. Placing a limit order, watching the price touch it, then reverse. Did you get in? At what price? So much slower, so much less certainty.
And information. Forget about it. You basically got the open and the close for the day. That was it.
Charting. Not on a screen. You drew them. By hand. Every day.
Sounds incredibly tedious compared to clicking a button now.
And his initial results reflected that learning curve, that first $20,000 account. Wiped out. Gone.
Then he moved the remaining $15K to another broker.
Lost that too. Which really drives home a key point. Just having access doesn't mean you know how to profit.
And it was those losses, right? That was the catalyst. That's what made him shift gears.
Absolutely. He committed to really studying trading, trying to figure out the keys to consistency, to profitability.
That's a step many struggling traders skip, isn't it? They blame the market, not their own approach.
It is. And this leads us to a really pivotal and honestly pretty painful learning experience for him. The silver trade. This was around 1980.
Okay, so he bought silver at $9.75 an ounce. 2 contracts. That was about $10,000 worth of exposure back then.
And almost right away, the market drops 20 cents. Boom, an immediate $2,000 loss.
Ouch. Tough start to a trade.
So his broker suggests this strategy. Buy one market, sell the other. A New York-Chicago silver arbitrage, trying to scalp tiny price differences.
Okay, but let's talk commissions back then, because that's a whole different world.
Oh, it was staggering. $125 per contract, per side.
Wow. Compare that to today, maybe $4 to $11 for like a mini Dow future. It's peanuts now.
It really puts it in perspective.
Yeah.
So just getting into that first trade cost him $250 in commissions, the arbitrage offset, another $250.
Then the market ticks up a bit. Broker says close this short. Market drops 20 cents again.
Broker says get short again, another $250 in fees. You see the pattern.
Yeah, it sounds like churning.
That's exactly what it was.
Yeah.
By the time silver got back to his original entry of $9.75, he was down $6,750, and the market had basically just gone sideways.
All that loss from commissions and tiny wick saws, while the price itself hadn't really moved overall.
And what's crucial for you, the listener, to grasp here is MDG Glass didn't really understand charting or market dynamics deeply yet. He was relying almost entirely on the broker.
And the broker was just racking up commissions, profiting from the churn.
It's a classic unethical practice, a stark reminder of how vulnerable traders were back then without independent knowledge.
The emotional toll must have been immense.
He talks about not being able to sleep, constant stress, anxiety. He finally just cracked, called the broker, said, "Get me out, everything."
And this timing connects to another major market event, right? The Hunt Brothers silver crisis.
Exactly. That period of absolutely wild volatility in silver. And the exchanges actually put in trading limits back then. Maximum price moves allowed in a day, like maybe 10%.
We don't really see those broad limits
Right.
much today.
Not like that. For silver, he remembers it being a 50-cent upward limit. So if it hit, say, $10.25.
Trading just stops.
Essentially, yeah. Because at that limit price, there were no sellers left. The market was locked, limit up. It is a mechanism, kind of a safety valve to slow things down.
Okay, so he gets out of all his silver at $9.75
Mm-hmm.
after weeks of chop and margin pressure.
Margin pressure being that stress when your account value drops near the minimum needed, forcing you to add funds or get liquidated.
Right, so he gets out, and then what happens?
Silver explodes. Within 30 days, it hits almost $49 an ounce.
Oh, that is painful, just brutal. From losing, sideways chop, to missing a moonshot.
And think about the psychology. When you're in a winning trade, you're constantly making decisions, right? Where to take profit? Where's my stop?
Should I get out now? Is it pulling back? Will it keep going? Constant mental juggling.
But in that specific Hunt Brothers situation, if he'd held on, no decisions needed, the market just kept locking limit up, forcing the price higher day after day.
So the pain wasn't from managing a winner. It was from the massive missed opportunity, driven out by frustration and bad advice.
And he makes a really key distinction here between paper losses in stocks versus realized losses in commodities.
With stocks, if the price drops, it's technically just on paper until you sell.
But in commodities back then, if your position lost value, the money literally left your account at the end of the day. It was a much more immediate, tangible loss. Felt different.
He talks about feeling totally powerless in that silver trade. After weeks of going nowhere, bleeding commissions, worrying about margin.
Even the thought of just reducing the position felt awful. He just wanted out completely.
And that whole painful saga led to a huge realization for him.
Yeah, that he had no real control, not over the broker, not over his own understanding. The broker's advice was clearly self-serving.
So that silver disaster, that cemented it. He had to truly understand trading, understand the markets himself, if he ever wanted consistent success.
And that realization is what prompted the move to Chicago, the heart of the trading world.
He knew he needed real mentorship, proper guidance. So he aimed for Merrill Lynch. Thought that would be the place to learn.
But getting in was tough. 1,000 applicants, he said, for just 3 trainee spots.
How did he pull that off?
He credits writing a really perfect essay, pouring everything into explaining his intense desire to be a broker.
And think about the risk he took. He left a secure, high-paying job in insurance, a contract worth like $360,000 over 3 years.
For an apprenticeship paying just $20,000, which he even had to essentially pay back from future commissions generated by clients.
People must have thought he was nuts.
Some did, definitely. Though he had some supporters too, but it was a massive leap of faith.
Then he gets to Chicago, gets into Merrill, but it wasn't quite the educational hub he imagined.
No, the disillusionment hit pretty quick. He expected to be surrounded by trading wizards eager to share their secrets.
But the reality was different.
Very different. He found most brokers didn't have deep, practical trading knowledge. The focus was heavily on sales.
Learning scripts, cold calling, opening accounts.
Exactly. And the underlying philosophy, especially in commodities, it was kind of grim.
How so?
He says commodity traders were basically seen internally as terminal cases. Clients who were statistically almost certain to lose all their money eventually.
Seriously, that was the view.
That was the prevailing view he encountered. So the goal from the brokerage side was just to generate as much commission income as possible before that inevitable wipeout.
Wow, that's pretty cynical.
He even remembers the head of Merrill's commodity division saying flat out, the average commodity client blows up their entire account in 6 months.
6 months. That's brutal.
Yeah.
And a stark contrast to floor traders, right?
It's a totally different world. Floor traders were risking their own capital, making directional bets based on what they saw happening right there in the pit. Brokers were mostly just order takers for clients.
Which brings us to another interesting transition. Floor traders moving to screens. That psychological shift.
Right. And funnily enough, MDG Glass was actually hired by the Chicago Board of Trade to help their floor traders make that leap to electronic trading. It was a huge mental adjustment for them.
And what did he observe working with them? Even the guys making money weren't always consistent.
Exactly. He saw that consistent profitability was actually pretty rare, even among those pulling money out of the market. He noticed this recurring boom and bust cycle.
Big wins followed by big losses.
Yeah, and the emotional fallout from those big losses, especially after a great run, was significant. He saw it took a heavy toll.
So he started categorizing traders based on their equity curves, their performance charts.
Right. 3 basic types. Type 1, consistently winning, smooth upward curve. Type 2, the boom and bust guys, big peaks, big valleys. And type 3, consistently losing, downward slope.
It's a useful way to think about trading progression.
And crucially, he points out that for the consistently winning traders, the dips in their equity curve, the drawdowns, those are usually just normal expected losses, part of any system, not necessarily mistakes.
But for the boom and bust guys,
their drawdowns are typically driven by unrecognized mistakes, self-sabotage, psychological stuff kicking in.
he tells a really vivid story about one specific trader, right? A case study.
Yeah, a super successful stock option trader on the floor, managing a huge $12 million account. This guy has a really bad day, and a friend suggests he talk to MDG Glass.
And did it help?
Apparently so. After working together, the trader pulled in $6.6 million in profit by the end of '92. Pretty impressive turnaround.
But then the boom-bust pattern strikes again.
Unfortunately, yes. He goes on vacation, reads a book about bond market crashes, gets spooked.
Oh no, don't tell me.
Comes back and starts shorting the bond market. By mid-February '93, he'd given back $4 million of those profits.
Wow. Just shows how external stuff, even reading a book, can trigger emotional trading that derails everything.
The trader eventually just hit a wall, exhausted, finally, genuinely ready to look at why this kept happening and make changes.
And what was the diagnosis? What did MDG Glass observe?
He realized this incredibly successful trader could only maintain peak mental focus for about 1 hour a day. Seriously.
Only an hour. What happened after that?
His concentration just frayed. He'd get reckless, impulsive. The intraday swings were wild, making and losing hundreds of thousands of dollars in minutes.
And emotions played a big part.
Huge. Anger, frustration. They often led to massive losses, especially on Fridays, apparently. It just shows how emotion can completely override skill. And you have to remember the scale he was trading at. Hundreds, maybe thousands of contracts. Tiny price moves meant huge money swings.
He gives that example of a bond future tick, right? The smallest price move.
Yeah, $31.25 per contract. Multiply that by thousands of contracts. A few ticks again to do is tens of thousands of dollars gone instantly.
The pressure must be immense. He uses that NBA analogy.
Right. High stakes game, final seconds, scores tied. Who does the coach put in? Only the players who are laser focused, mentally locked in, not the ones who are rattled or tired.
And the floor itself was distracting.
Insanely distracting. Shouting, hand signals, noise, speed, opportunities vanishing in seconds. You had to be totally present. But for this guy, that peak mental state, it only lasted about an hour.
So what was the solution they came up with?
Surprisingly simple, in concept anyway. Limit his trading to just that one high-focus hour each day.
And the result?
An average daily profit of $175,000 just from that 1 hour of focused trading.
Incredible. He was, as MDG Glass said, kind of an extreme example of that boom and bust type, driven by psychology.
Which brings us nicely to MDG Glass's own personal rock bottom and the turning point that really crystallized his whole philosophy.
He was under serious financial pressure, right? Juggling living costs in two cities, Michigan and Chicago.
Yeah, and he even had a secret trading account at another firm, which was a big no-no at Merrill Lynch for employees.
Shows how badly he believed trading was the answer to his money problem.
He just had this deep gut feeling, this intuition that trading was primarily psychological. It wasn't just about charts and numbers.
His first trading book wasn't technical analysis.
No, it was Trading Psychology by Gerald Nenner. That early focus on the mental side was key.
He was also journaling everything. His thoughts, observations of others.
Meticulously. His own thinking, watching other brokers, client interactions, and he started seeing patterns, shared issues, recurring struggles among traders.
And that led him to conclude that trading skill is mostly mental.
Predominantly mental, yeah. The physical part. Clicking a mouse, it's minimal. Which is deceptive, right? It makes people think trading should be easy.
But the psychological skills needed are incredibly complex. And the biggest one,
learning to trade without fear, getting fear out of the driver's seat.
Because fear, he argues, is the root cause of almost all mistakes.
Yeah.
It twists how you see the market, makes you hesitate, or makes you jump in impulsively.
And he talks about the frustration of asking successful traders for advice back then. What did he get?
Vague platitudes, right? Follow the trend, cut your losses, let profits run.
Exactly. Stuff that sounds simple, but with zero practical guidance on how to actually do it consistently under pressure.
Learning to cut losses is hard enough for most people.
But learning to let profits run, psychologically, that can be even harder. The urge to grab a small gain before it disappears is powerful.
Meanwhile, his own financial situation was getting worse.
Yeah, escalating pressure, mounting credit card debt. It reached a point where he was completely wiped out financially.
And he made the tough call to file for bankruptcy.
He did. And he chose to file back in Michigan, partly to keep it under the radar from Merrill Lynch in Chicago.
But that low point, filing for bankruptcy, that unexpectedly became the turning point.
Paradoxically, yes. Because filing for bankruptcy, as devastating as it was, it actually freed him from the constant, paralyzing fear of financial ruin. That worst-case scenario had happened.
And here's the wild part. Even at his personal financial bottom, he was still managing client money at Merrill.
Right, so he was still in the markets daily, but suddenly without that intense personal pressure, that desperate need for his next trade to work out.
And removing that fear, it changed how he saw the market.
Profoundly, immediately. He describes it like taking off foggy glasses. Suddenly he could see patterns, opportunities, with a clarity he'd never had before.
The fear had literally been distorting his perception.
Yeah, completely. And he started trading with this ease, this natural flow, and guess what? His clients started becoming consistently profitable.
That's amazing. And there's that client story that illustrates this perfectly. The guy from the Illinois State Computer Department.
Yeah, brilliant guy. Developed his own trading program using state computers, apparently.
He had an old, unfunded account at Merrill from previous losses. MDG Glass took it over.
Their initial contact was just daily calls, basic data exchange, high, low, close.
But then they started collaborating, refining the system, adding crucial money management rules.
Which is so often the missing piece for people. And soon, all of MDG Glass's clients using the system, they started making money consistently.
Which finally got Merrill Lynch's attention. In a good way for once.
Right. But here's the twist. The client himself, the guy who built the program, he decides to try trading it himself with $5,000.
And despite seeing it work consistently under MDG Glass's management,
he blows up the entire $5,000 in 2 days. Why? Because he completely ignored all the rules. Threw discipline out the window.
just goes to show, you can have a great system, but if the psychology isn't right, if you can't follow the rules,
it's useless. So the client stopped trading, and MDG Glass lost access to the system since it was on state computers. And then came another twist.
His dismissal from Merrill Lynch. How did that happen?
Yeah, totally unexpected. A fund management consultant visits from New York. MDG Glass is excited, shares his work on the disciplined trader, his psychological insights.
Thinking this consultant would be impressed?
Exactly. The consultant seems enthusiastic initially, then has a quiet word with the branch manager.
And boom.
Boom. MDG Glass is called in and fired. Immediately. Just like that.
Wow. So Merrill Lynch let go of someone who was finally making all his clients' money consistently. Seems odd.
It does seem odd from the outside, but sometimes large organizations work in mysterious ways. Maybe they didn't like his methods, maybe it was office politics, who knows? But it happened.
But that setback actually pushed him into his real calling.
It did, kind of by default. Suddenly, he's out of a job, but floor traders who knew about his insights started coming to him for help. Hey, can you work with me like you did with so-and-so?
So he became a trading coach.
Exactly. Got referrals. Clearing firms even started hiring him to work with traders who were deep in the red, owing the firm money.
Because clearing firms get nervous when too many traders blow up, right? It puts the firm at risk.
Big time. So working daily, intensely with those floor traders who he describes as fundamentally different psychologically from most retail folks, that's what really formed the bedrock of his books and his whole approach.
Okay, and this leads to a really important concept he talks about, the profit gap.
Yes, he noticed that most traders he worked with actually had decent trading methods, systems that could potentially generate consistent income.
But there was this gap, right, between the system's potential and their actual real-world results.
Yeah.
Often a huge, frustrating gap.
Huge. And the common assumption, the flawed belief, is that closing that gap means finding more market knowledge.
A better indicator, a secret pattern, more news.
Right. More external stuff. But MDG Glass's crucial insight was, no, that's not where the answer lies.
The gap is closed by understanding yourself, your psychology.
Precisely. Understanding how you interact with the platform, with the market's uncertainty. It's about mastering your psychological skills.
Like managing anger, which you mentioned earlier.
Exactly. Think about that pro basketball player again. He knows how to shoot a free throw. He has the physical skill down cold.
But under pressure, game on the line, crowd screaming, he might miss. Why?
Psychology, pressure, fear, lack of focus in the moment. It's the same in trading.
So fearless trading, that core skill we started with, that's what lets the pros avoid those common emotional traps.
That's the key. It allows them to transcend that conventional, often fear-driven thinking that plagues so many traders and prevents them from executing their potentially good systems properly.
So thinking like a professional trader, it's not just about being smarter about markets.
Not primarily. It's about cultivating that inner mental game, getting past those limiting beliefs and fears so you can actually use the potential of whatever method you have. Your psychology is the gateway to your method's potential.
Okay, so let's wrap this up. To recap this deep dive into the professional trader's mindset, the path to consistent profits. It's not about chasing some holy grail system.
No, it fundamentally comes down to mastering your own psychology, learning to trade without fear calling the shots.
And that means developing self-awareness, really understanding your emotional triggers in the market, how anxiety or greed or frustration can mess up your plans.
Recognizing how those emotions sabotage you. And the good news is that journey from fear-based trading to confident execution, it's possible. It takes work, mental training.
But it's a learnable skill set. It requires looking inward, understanding your own mental landscape.
So here's a challenge for you listening. Take some real, honest time to think about your own trading mistakes. Go back through them.
And ask yourself, how many of those errors, when you really break them down, trace back to fear? Or hesitation? Or maybe just plain old self-doubt?
Be brutally honest. Where did the mistake really originate?
And maybe a final thought to leave you with, something provocative. If the best, most consistently profitable traders out there, people like MDG Glass, keep hammering home that psychology is the most critical element,
More important than the specific entry or exit signal.
then what concrete steps are you going to take? What will you commit to doing to really understand and master this vital part of your own trading journey?
This deep dive hopefully gave you a starting point, some key insights, but the real work, the introspection, the mental discipline, that always begins with you.